Okay everyone, Assalamu alaikum and welcome to ACCA revision sessions for paper F7 financial reporting. I'm your trainer Hamza Abdullah and today is the first session on 13th November 2017. Let's start the session with the basic tutor profile. I'm an ACCA member with an experience from Deloitte, Pakistan, teaching since last 9 years, and I have been teaching paper F7, F9 and P2 in the past. Have produced multiple nationwide positions in different attempts, and historically have been producing pass rates above the global pass rates throughout my teaching career, and have also conducted multiple training sessions on IFRS, which have been officially conducted by ACCA and ICAP. ICAP is the local body of chartered accountancy. What is the agenda of the session? We are going to have a quick revision of the core topics of paper F7. We are going to practice some of the section A type questions, some of the section B type questions, which will be objective test questions, OT questions, and we will be solving some of the practice questions for section C, which are known as constructed response questions, CR questions, and we will be having discussion over different exam techniques in this video. Let's start with the basic F7 paper pattern on how the paper is going to be structured. Paper will be having three sections: section A, section B, section C. Section A will have question number 1 to question number 15, and so there will be 15 OT questions of 2 marks each, which will make a total of 30 marks. Section B will be from 16th question to the 30th question. So this will be having 3 OT case studies with 5 OTs each. So which means 15 OT questions again, but 3 cases, 15 questions, which will be of 2 marks each. So that will again become 30 marks. And then question number 31 and 32, there will be 2 further questions, which will be constructed response questions, and these will be of 20 marks each. So this will make a total of 40 marks, and the final total will become of 100 marks. So this is the total breakup of the exam. So section A will be of 30 marks, section B will be of 30 marks, and section C will be of 40 marks. So this is the complete breakup. So if you are able to perform good in section B and section C, this will automatically become 70 marks. So in 70 marks, a well-prepared student can even pass within these 70 marks. So if you are well prepared for section C and section B, that is enough for you to pass the paper. The good thing of section B is that, for example, if there are 3 case studies, so this will mainly belong to 3 major areas: maybe consolidation, maybe cash flow, maybe ratios, or maybe any accounting standard. So when you are preparing for a section C type question, that will automatically cover a lot of section B type questions as well. Apart from those, there will be certain accounting standards which are major accounting standards which can be asked in section B. Obviously, the minor ones cannot be asked in section B because the examiner won't be able to prepare 5 questions from each standard. So this is the overall paper pattern. Now let's discuss the paper linkages of F7. The paper F7 is basically an advanced paper of F3, and the knowledge will be carried forward to the professional level paper P2, which is corporate reporting. So financial accounting knowledge is carried forward to financial reporting and then carried forward to corporate reporting. Apart from F3, some of the knowledge, the dotted line denotes minor knowledge transferring, and the constant line denotes a major content transferring. So some of the basic parts will come from paper F4 and will go to paper F8. So the strong knowledge of paper F7 will automatically help you in F8 as well, and some of the knowledge will be carried forward to paper P3 as well. And paper P3 is going to be conducted up to June 2018. After that, this will become SBL. So paper F7, the knowledge is being carried forward to 3 different papers: P2 mainly, some of P3 and some of F8, and the knowledge brought forward is from F7 and some of F4. So these are the paper linkages of paper F7 with different other papers of ACCA. Now these are the syllabus areas, the capabilities required to pass paper F7. There are total 4 sections: Section A, Section B, Section C, and Section D. So these are 4 syllabus areas of paper F7. The orange color basically denotes a low priority area. The other area denotes a normal priority area, and the green sign denotes the top priority area. So there are 3 types of different areas: the conceptual and regulatory framework for financial reporting. So framework is normally being asked in section number A. So you can expect 2 to 3 questions from the regulatory framework, which includes the conceptual framework and the regulatory framework both. Apart from this, section C relates to analysis and interpretation of financial statements. This is comparatively a more important area. This question is being asked normally in section C only. Plus in section A, you can expect 1 to 2 questions. 1 to 2 questions in section A. And apart from this, the accounting transactions in financial statements, the part B, is one of the most important areas, because this is going to include all of the accounting standards, and this is going to include the final accounts. By final accounts, we mean the preparation of the financial statements, and part D basically includes the preparation of the financial statements. So in part B, basically the areas included are the accounting standards, and in part D, this includes the preparation of the financial statements, which would include both entity financial statements, which means individual financial statements, and the group financial statements, which means consolidated financial statements. So these are the capabilities that are required for a student to pass the F7 exam. Now let's look into a more detailed view of all of these areas. The part A basically have 2 areas: the conceptual framework and the regulatory framework. Now the conceptual framework is comparatively more important as compared to the regulatory framework. So even if you have completed conceptual framework properly, you should expect that the area has been covered. The regulatory framework can be asked as a maximum 1 section A question in the exam. So you can even leave the regulatory framework while going into the exam, only if you have a less time. But you have time, go through these in detail, and don't even try to miss a single question. But maximum question is 1 from section A. Similarly, in part B, there are different accounting standards. Some of them are more important and some of them are comparatively less important. So the first point is tangible non-current assets, which would include IES 16, IES 23, and IES 40. These 3 areas are included in this. This would include the financial instruments, which means IES 32 and IFRS 9. This would include leasing, IFRS 16, taxation, IES 12, revenue, IFRS 15, impairment of assets, IES 36, and foreign currency transactions, IES 21. So these are comparatively more important areas as compared to the rest. And in the rest, we have inventory, which would include biological assets. So this means IES 2 and IES 41. Provisions, IES 37, and events after the reporting period, IES 10. This is comparatively less important as compared to the others. And then we have government grants, which is IES 20, and intangible assets, which is IES 38. So these are comparatively more important than these. Then in part C, we have calculation of ratios and interpretation of the ratios. This is comparatively more important. And the limitation of financial statements and the limitation of ratio analysis is comparatively less important. And then in the part D, we have the preparation of the financial statements, which would include entity-specific financial statements, which means individual financial statements, which we also call the final accounts. And this also includes the cash flow statements. And then we have a different part of consolidated financial statements. So this is a breakup of the entire F7 course that a student should be prepared of before going into the exam. If you people have any question, you people can simply post them onto the question bar. So if you are posting over there, we can easily know your questions. Okay, now let's discuss the agenda that we are going to cover in this revision session. In day one, we are going to cover the accounting standards, which would include the tangible non-current assets, 1640-23, financial instruments, taxation, and revenue. These are the areas that we are going to discuss in today's session. And then in day two, we are going to continue the accounting standards, where we are going to discuss IFRS 16, leases, intangible assets, impairment of assets, non-current assets held for sale, and the government grants. So these areas will be covered in day two, and then we are going to solve one of the final accounts questions by the name of triage in day number two. In day three, we are going to continue the final accounts and we are going to solve further two questions. And if we get more time, we are going to solve any one more question depending on the time. And if any of the thing is being left in day two and we are not going to and we are not able to cover that in day two, then we will be covering that in day number three. Day four would relate to the consolidated financial statements, where we're going to solve two different questions, Dargin and Laurel. And in day number five, we are going to discuss ratios, and again two questions, Funkjet and Landing. And day number six is going to be a mock debrief session. You people are going to receive a mock exam, and then that mock exam will be discussed in day number six. So this is the entire plan of action that we are going to cover in today's session. If you people have any question, you can ask. Just give me a second, please. Okay, so now I'm back and I can see your list of questions now. So Simran is asking, is it important to remember IESs? No, Simran, you are not required to remember the IES number and the name. If you remember the accounting treatment, that is more than enough, because that is what will be scoring the marks. And Bilal is saying, since long time there is no final accounts question and cash flows, so won't we be covering the cash flows? And Lee Davis is asking, we won't be doing foreign currency. Simran is saying test. Shiza Salim is saying, what about cash flows? Fawad Ahmed is saying, what happened? Okay, Fawad, nothing actually happened. I was not able to see your questions. So that's why I just paused the session to gain the access of the list of questions. So now the questions are with me. And let me answer all of your questions. The major question is that, what about cash flows? So basically, cash flows is a type of a question which is comparatively less expected in each of the sessions, because that is a comparatively easier section. So my colleague Hamad Sarwar would have covered the cash flow statement area in the previous webinar of September 2017. So you people can access over there, day number 1 that was, and you people can cover the cash flow statement from over there. So we will be focusing more on the areas that are more important for the paper. So that's why I had decided not to cover the cash flow statements. Otherwise, I will have to reduce some of the accounting standards. And I think you people would obviously know that we have a limited time. We have a limited time of 15 hours, and we cannot cover everything in this 15-hour session. So we actually have to pick some of the important areas, and we can only cover that, obviously. So this is the limitation of time. So that's why I think covering cash flow statements would cost more as compared to not to cover that. And Simran asking, is it on Vimeo cash flow day 1? Exactly, Simran. You can access Vimeo Pakistan channel, and there you can find F7 for September 2017 attempt. You will find it over there. And then Bilal Ahmed is saying, sir, IFRS 15 is new. No, Bilal, IFRS 15 is now comparatively older. It was being examined. It is being examinable since 2015 July. Neeraj is asking, sir, shall we get questions of consolidation in MCQs, MTQs, or just in long questions? Let's see. Neeraj, I'm going to discuss all of these areas. Sometimes the discussion is there, but it would take some time. So this is an overview of the plan that we are going to follow in this revision session. Let's continue, and then we are going to discuss even more. Now, this is an analysis of section C. In the specimen exam, the section C question was relating to final accounts and ratios. This is not a past paper. This is a specimen exam. In September 16, again, final accounts and ratios was there. In December 16, consolidation ratios was there. March 17, consolidation ratios. June 17, final accounts ratios. And September 17 was a consolidation ratios. Now, for December 2017, I would say that you should expect a ratios question to be there. Ratios question will be there. And with this, the higher chances are of final accounts question with the ratios, but you should also expect a consolidation question, because if we see the consolidation was repeated in December and March, so it may be repeated again in September and December. So one cannot say that if the consolidation has been asked in the previous attempt, it is not going to repeat. It may be get repeated. The final accounts was repeated in the specimen and the September 16 attempt. So be prepared for every possible question. Be prepared for consolidation. Be prepared for final accounts. Be prepared for ratios. Be prepared for cash flows. Do not expect that this will come and this will not come. But considering the time constraint, if you have to decide something to leave cash flows. If you don't have time and you want to leave something, then leave cash flows. Otherwise, try to cover even that. Mohammad Nabil is saying, sir, any changes in leases? Mohammad Nabil, IFRS 16 has now been introduced, so IS 17 is no more. So from now onwards, IFRS 16 will be applicable. So we are going to study leases according to IFRS 16. Okay, Mohammed Suhaib, that is something new that you are telling. Let me check again for this. Okay, Sayyid Ayaz saying hi. Hi, Ayaz. Okay, now let's discuss one more thing and then we are going to start the accounting standards. If we talk about section number A, in section A, the question can be from anywhere from the syllabus. In section number B and section number C, which areas can be asked? Section number C is mainly either the consolidation or final accounts. By final accounts, we mean entity-specific financial statements, individual financial statements, or ratios. These are the three areas which are most common in section number C. But apart from this, the question can even contain cash flow statements. The question can even contain a cash flow statement question. So these are the four areas for section C, but higher chances are of these three areas. And the cash flow question can be a part of final accounts, a minor part of the final accounts, 5 marks to prepare operating activities or investing activities or financing activities, or cash flow question can be there in section A and section B. So now section B, for example, if I say that section C contains a final accounts and a ratios, then section B may contain a question of consolidation. And plus, this would also relate to some of the accounting standards. So after the MCQs being introduced in the course, it is very important that you should have an overall course coverage rather than targeting any area, that this should be studied and this should not be studied. This is not a good option, because after the introduction of MCQs, the 60% of the questions are MCQs. So they can be from anywhere in the course. So it's better that you people prepare for every single area. Shiza Salim is saying EPS. Shiza, EPS is a lengthy area that will consume approximately an hour minimum, because there are three different areas: the basic EPS, the comparative EPS, and the diluted EPS. So considering the time constraint, we have not decided to cover the EPS. Bilal Ahmed saying is, what is IAS 23? Good, Bilal. IAS 23 is basically borrowing cost. IAS 23 is borrowing cost, and we are going to cover this in the first area. So now we are starting the first area of tangible non-current assets, which will cover IAS 16, IAS 40, and IAS 23. These are three different areas that are going to be covered. An overview of all of these areas, we are going to discuss the scope, that which asset is accounted for in which IAS in what cases. Initial measurement, how do we record the asset when it is initially being recorded in the financial statements. Then we are going to discuss the depreciation, then revaluation, then derecognition, and then borrowing cost. This is IAS 23. And then we are going to discuss investment property, which is IAS 40. Again, I would like to remind you people that we have a short time. We cannot complete the entire course in the 15-hour session. So we will be trying to maximize what we can do. So let's start with the scope. Property, plant, and equipment. So for property, plant, equipment, we can classify these properties in 4 different accounting standards. This can be classified in IAS 16. This can be classified in IAS 40. This can be classified in IAS 2 inventory. And this can even be classified in IFRS 5. So there are 4 different accounting standards where a property, plant, equipment can be classified depending on the use. So it is classified in IAS 16 if the intention is to use or to earn rentals. In IAS 16, property, plant, equipment is being classified when the intention is to use or to earn rentals. But I have written something in the bracket that other than property. If a property is being held to earn rentals, that would become IAS 40. If a property is being held to earn rentals, that would become IAS 40, and anything other than property held for rentals is IS 16. So for example, if I'm giving this pen onto rent to you people, this is IS 16. I'm giving the tablet to you people on rent, this is IS 16. I'm giving the camera to you people on rent, this is IS 16. I'm giving the laptop to you people on rent, this is IS 16. I'm giving a vehicle to you people on rent, this is IS 16. But if I'm giving a property to you on rent, that is IS 40. Only properties that are being held for rental purposes are being classified under IS 40, and all other areas for rental purposes are being classified in IS 16. Nazia Zubair is saying the limited course is enough to pass. Yes, Nazia, I've designed the course sufficient enough so that you people can easily pass from this course. So the course has been designed to pass you people, obviously. And Jacqueline is asking that, is there enough time for now till the exam to prepare and pass? Why not, Jacqueline? The time is more than sufficient enough for you people. You still have approximately 3 weeks. So 3 weeks are more than enough to pass two papers. But for that, you need to study smart. If you're trying to study everything and you want to cover everything, you cannot cover. So the resources are always limited in life and you cannot live a perfect life. So what do you want to do is that you have to create a balance between the life, that this should be done and this should not be done. So life is all about balancing situations. Bilal is saying laptop on rent, laptop is also property. Bilal, by property we mean land and building. By property we mean land and building. The property word does not mean the ownership. The word property means land and building. So apart from land and building, everything else given on rent is IS 16. But if I am giving the land on rent, it is IS 40. I'm giving building on rent, IS 40. Now, if property, plant, equipment are being held in the normal course of the business, which means that my business is to buy an item of plant and to sell it, that would become my inventory. If my business is to buy the pen and then sell it into the market, this is my inventory. If my business is to purchase the laptops and sell it into the market, this is my inventory. So anything in the normal course of the business, which means for business operations, would become IS 2. And the third thing is that if an item is being held for sale, for example, I'm using this tablet and after using it, I want to sell this. I'm using the tablet and after using this, I want to sell this. Now, once my intention has been developed to sell, it would become IFRS 5. If my intention is to sell, this would become IFRS 5. Assuming certain criteria are met, obviously, that we are going to discuss in IFRS 5. But if an item is being held for sale and meeting the criteria, that would become IFRS 5. Okay. Simran is saying, what is property agent? Simran, I think this is not relevant. Property agents are not being there asked in paper F7. And the last thing is IS 40. In IS 40, the property, plant and equipment would fall where the objective is to earn capital appreciation and or to earn the rentals. But IS 40 would apply only onto the property. This would apply only on the property. So anything other than property will not be classified in IS 40 because the name of IS 40 is investment property. Properties which are being held for investment purposes, and by investment we mean either the capital appreciation or to earn the rentals. So now there are total 4 accounting standards: IS 16 where the intention is to use or to earn rentals other than property, IS 2 where I have the asset in the normal course of the business, IFRS 5 where my objective is to sell the asset, and IS 40 where my objective is to earn capital appreciation and to earn the rentals. Similarly, if I have a property, which means land or building, I have a property, a land and building, and I don't know why I have kept it. I don't know why I have kept it. I may use it, or I may give it to someone on rentals, or I may keep it for capital appreciation. My intention is not defined. I'm not even sure myself about what is the use of the property. So such properties will also be classified in IAS 40, where we have an unidentified intention. We ourselves don't know why do we have the property. So an example be like this. For example, if I had a property and considering the recession in the market, my use in the property has been reduced. And now this property is unoccupied property. I'm not using this, but I've kept it so that if the business regrows, I will use it. If the business does not regrows, I will give it to the rent. And if I don't find anyone to take the property on rent, I will simply earn the capital appreciation. Now my intention is not defined. It may be any side. So in this case, again, we are going to classify it in IAS 40. Walaikum Assalam, Shazia Muhammad. Okay, Simran has a question. I mean, what about property agent? The property comes under IAS 2 or IAS 16. Okay, basically, Simran, for property agents, the property never belongs to them. If you have a property and someone wants to buy, I am the agent. The property is not mine. If the property is yours and I have a buyer, I'm the agent. You are selling it to the buyer through me. I'm the agent. So the property is never mine. The property is yours. And you are selling to the buyer. I'm nowhere there. The agent is only connecting two people and earning a commission. So for the agent, it is not an asset. For agent, it is only an income, a revenue. Okay, Maz has a question. Good question, Maz. Let me discuss with everyone else. Ayaz is saying we earn rentals in IAS 16 and even in IAS 40. What is the difference between these? Ayaz, I think you have joined late. I've already discussed this. That the rentals, the objective to earn rentals in IAS 16 belongs to something other than the property. And IAS 40 belongs only to the property. So if I'm giving this pen on rent to you, this is IAS 16. I'm giving the laptop to you on rent, IAS 16. I'm giving the camera to you on rent, IAS 16. I'm giving a property, a land and a building to you on rent, this is IAS 40. So the difference is the type of the asset. If the type of the asset is a property, a land or building, IAS 14. Other than property, IAS 16. This is the core difference between both of them. Yes, Ali El Maki, we will be providing you the recorded lectures for your use later on. Abdullah is asking, so what is meant by capital appreciation? Abdullah, capital appreciation means an increase in the value. So for example, I've purchased the land for $10 million and my intention is that when the fair value will increase to 12, 15, 18, 20, I will sell it. This is called capital appreciation, earning the increase in the market value. So if I have purchased the property for 10 and I want to sell it for 12, 15, 18, 20, that would become capital appreciation. Yes, Neeraj. Capital gain and capital appreciation is the same. Thank you, Doom Nigo. Your name is quite difficult for me, but thank you so much. Okay, so now we have discussed the scope of when to classify the property in which IAS. Let's move further. I will be providing you people a link to the WhatsApp group, my F7 WhatsApp group, where people normally ask questions with each other and normally the students are able to answer them. And if these students are not able to answer any question, I then interfere and answer that. So first I give priority to other people to have discussions between each other, and any unanswered question is then being answered by me. Bilal is asking, sir, in which college do you teach? Bilal, I teach in KNS Institute of Business Studies in Karachi, Pakistan. Okay, now let's discuss the initial measurement. How do we record the asset initially in the financial statements? So for initial measurement, we say that the property, plant and equipment should initially be recorded at cost. property, plant, equipment should initially be recorded at cost. Now, what do we mean by cost? The cost includes all costs necessary to bring the asset into the working condition for its intended use. The cost includes every cost necessary to bring the asset into its intended use. So for example, if I'm purchasing a plant, I'm paying the purchase price, and then I'm paying the transportation cost to bring it into onto my place. Now I have paid the purchase price, I have paid the traveling cost, and then I have paid the installation cost, and then I have paid the testing cost. All these costs are necessary to bring the asset into its intended use. So all these costs will actually be capitalized. So now the asset can be either two ways. Either I'm going to purchase it or I'm going to self-construct it. I'm going to construct it myself. So if the asset is purchased, the first thing that I'm going to pay is the purchase price. But for example, if the listed price is $100 and I get a trade discount of, let's say, $10, so the price is actually $90. So the price that we are going to capitalize is not 100, we are going to capitalize 90. The price after the trade discount. So we are going to capitalize the price after the trade discount, which is 90. Plus, if I have paid any non-refundable taxes and duties, that is also a part of the asset. Okay, Mehtab has a long question. Mehtab, let me continue and then I will get back to you on this because your question would take longer time. So now I have paid the purchase price of 90 after the trade discount, plus I may pay any of the taxes and duties. If those taxes and duties are refundable, if the taxes and duties are refundable, I'm going to get them back. That is not a cost to me. If I'm going to get back the taxes and the duties, that is not a cost to me. That is a type of a receivable. That is not expense. So only taxes which are non-refundable will be capitalized in the cost of the asset. Refundable taxes and duties, no. Then we have the directly attributable cost, which means any cost which has been incurred because of this, such as transportation cost, such as installation cost, such as testing cost. All these costs are part of the directly attributable costs. And then finally, we have a dismantling cost. Dismantling cost is comparatively more important as compared to the others because sometimes the dismantling cost question is asked as a separate question in the MCQs or in the final accounts. So what is a dismantling cost? By dismantling cost, we mean uninstallation cost. By dismantling cost, we mean uninstallation cost, removal cost. There's a cost of installation and there's a cost of uninstallation. So both the costs are being capitalized. In the exam, the dismantling cost can be used with different names such as decommissioning cost, uninstallation cost, removal cost, decontamination cost. All these costs are more or less the same. The words are being used interchangeably. Sheikh Saqib Hassan is asking, what about cash discount? Sheikh Saqib, cash discount is basically treated as another income. That is not adjusted with the asset. That is treated as another income. Wa alaikum assalam, Hamza Ali. We are going to discuss this under IFRS 15. Hamza, your question relates to that area. Smita is saying, Sir, can you please explain again the non-refundable taxes and duties? Ayaz is saying, all these four costs will be a part of the asset as capitalized cost. Yes, Ayaz, all these four are a part of the cost of the asset and will be capitalized. Okay, one thing I would like to tell you people that we are going to discuss the dismantling cost in detail. A lot of people are asking about dismantling cost. So I am not still done with the dismantling cost. We'll be discussing this and we will even be solving one of the past papers questions on the dismantling cost. So I'm going to tell you the question over there in much more detail. So be rest assured, your confidence is my confidence, your success is my success. If I'm not being able to pass you, that is my failure. So I'm sure that I won't fail. So be rest assured, be rest assured. I will be discussing everything in detail with you people. So the dismantling cost will be discussed in this slide. There is in this slide, but give me just few minutes and then we will discuss this. Welcome, Simran. Okay, so now we are capitalizing actually four things: the purchase price after the trade discount, any non-refundable taxes and duties, such as, for example, if I'm importing an asset, I have to pay the import duty. Do I get it back? No. So that is the cost of the asset. Similarly, if I'm paying a sales tax, that I'm going to get a refund. I'm paying a sales tax that I'm going to get a refund. Is this going to be capitalized? No, because this is a refundable tax and this is not a cost to me, because anything that I'm paying and then getting it back is not a cost. The cost is the amount that I've paid and I am never going to get it back. Can you get the purchase price back? No, non-refundable cost of the asset. Can you get the installation cost back? No, that is a non-refundable cost. This is going to be capitalized. But any tax that I'm going to get back is not a cost, will not be capitalized. So the purchase price after trade discount, not cash discount. Non-refundable taxes and duties, any tax or duties which I'm not going to recover. Directly attributable cost, transportation cost, installation cost, testing cost, any other cost. And fourth, the dismantling cost, the uninstallation cost. These are the four areas that are going to be capitalized. Now, if the asset is self-constructed, we are constructing the asset on our own. So we would be using the material. The material cost is going to be capitalized. Both if it is direct material, that is also capitalized. And if it is an indirect material, that is also capitalized. The material cost will be capitalized irrespective of whether it is direct or indirect. Similarly, the labor cost, the labor that I'm using to construct the asset, will also be capitalized. Both again direct and indirect, both the labor will be capitalized. But for the overheads, only directly attributable overheads will be capitalized. The indirect overheads will not be capitalized. Material, direct, indirect, both will be capitalized. Labor, direct, indirect, both will be capitalized. But overheads, only direct overheads will be capitalized. Indirect overheads will not be capitalized. And then same, the dismantling cost. So we can say that these 2 points are the same. These 2 points are the same. The directly attributable cost, the directly attributable overhead means the same. Dismantling cost means the same. The only difference is that I'm not paying the purchase price. Instead, I'm paying the material and the labor. So for example, if I have to prepare a house, one option is go and purchase a house. One option is to go and simply purchase the house. And second option is to hire the labor, bring the material to them, and they are going to build the house for you. So the self-constructed asset means that we are developing it internally, and purchased asset means that we are purchasing from someone who has already developed it. So this is the basic difference of the both. Okay, Simran, I think you are going into too much of detail. You do not have to mix F6 with this. There is nothing as tax registered company or not registered in IF7. The question will inform you clearly whether the tax is refundable or non-refundable. So your work is to apply the IES and not to link it with the paper F6. Lee is asking that would IS 23 apply to self-constructed asset? Yes, Lee, we are going to discuss this later. Simran is asking what is indirect materials and indirect labor. Simran, you are asking something you have already studied in paper F2 a long time ago. Ask this on WhatsApp group. I will answer you over there because this is something not very much important. Okay, Kohli is asking that cost of the asset has to do with all the costs incurred bringing the asset to use. Is training cost for the staff to use the plant purchased inclusive? Okay, Kohli, this is a good question. Harish is again asking for the borrowing cost. Again, I would like to inform you, all of you people, that we are going to discuss borrowing cost in detail. We are going to discuss borrowing cost in detail. Right now, I'm not mixing it so that we can study it separately, and then we are going to combine them differently. Now, there's a good question, and I want all of you people to answer that. For example, I have purchased this asset, I have purchased this tablet, and now my employees don't know how to use. And I'm giving them a training session which has a cost. I'm giving a training session which is a cost. So is that training cost going to be capitalized or not? Is the training cost going to be capitalized or not? You people have to answer this. Are we going to capitalize the training cost? Sayyid Saad Farooq is saying yes. Bilal Aslam saying no. Omni is saying no, not capitalized. Sharshu PNL, no, yes, no. Okay, a lot of no's. Thank you so much. Yes, actually the training cost is not going to be capitalized because that is not a cost to bring the asset into use. That is the cost to use. That is the cost to use. That is not to bring the asset into usable condition. Now this tablet is in a usable condition. I don't know how to use, that is my problem. There is no problem with the tablet. There's no problem with the asset. So if I'm paying any training cost, that is not a part of the cost to bring the asset into intended use. Instead, that is a cost to use. That is a cost to use. Therefore, that will not be capitalized and instead be expensed. Okay, so a lot of good answers from you people. And this shows that you people are not blank. That's good. Okay, now, so we have discussed for the purchase asset, we have discussed for the self-constructed asset, and now we are going to discuss the accounting for dismantling cost. Now, what is the accounting for dismantling cost? There are 3 steps that you have to remember. Dismantling cost is capitalized in the cost of the asset. We are going to capitalize the dismantling cost at its present value. We are going to capitalize the dismantling cost at its present value. So if I write the double entry over here, I'm going to say for the first bullet, we are actually debiting the property, plant, equipment, and we are crediting a provision for dismantling. So the first entry actually means debiting the property, plant, equipment and crediting the provision for dismantling by which amount? By the present value. So we are going to capitalize the dismantling cost at its present value. And then we are going to depreciate it along with the asset. So for example, if the cost of the asset was 100, and the present value of dismantling cost is 10, so the total cost would become 110, and now we are going to depreciate 110 over the life of the asset. So let's say the life is 10 years. So we are going to actually charge depreciation of 11, and the net book value in the balance sheet is going to be 99. So the first step is to capitalize it in 100, make it 110. The second step is to depreciate 110, due to which the cost is also depreciating and the dismantling cost is also depreciating. Both are actually depreciating. So the 11 actually includes 10 depreciation of the cost and 1 for the dismantling cost. So the total depreciation is 11. So we are actually also depreciating the dismantling cost along with the asset over 10 years life. And then we are going to unwind the liability at each year end. The word unwound is basically a past tense of unwind. So both are the same. Unwind is the present tense and unwound is the past tense. So we are actually also studying English over here. So unwound at each year end, the liability is unwound at each year end, or unwind the liability at each year end means the same. Okay, Simran, I'm explaining the double entry again. Wahid is asking, sir, insurance cost would be capitalized or not? Basically, Wahid, insurance cost is not a cost to bring the asset into usable condition. So if the insurance is not necessary, this is a separate asset. If the insurance is not necessary for the asset, it is a separate asset. And if the insurance is necessary, then it will be a part of the asset. So for example, if I'm shipping a plant from somewhere else, so the shipment has a requirement that the asset should be insured during the shipment process. The shipment has a requirement that the asset should be insured during the shipment process. That would be capitalized. But if the insurance is not necessary, that would be treated as a separate asset and not as a part of the asset itself. Dania, dismantling cost is 10. Dismantling cost is 10 and the cost of the asset is 100. So this has become 110. Yes, Allah Nawaz, I am coming towards this. So the third point was that we have to unwind the liability at each year end. So now 10 million was the dismantling cost. This is a liability, this is a provision. Now, for example, if we have used a discount factor of 10%, if we have used a discount factor of 10%, we are going to unwind the liability by 1, and the liability at the balance sheet date is going to be 11. So 100 was the asset, 10 capitalized, becoming 110. Depreciating 110 over 10 years life would become 11, and then unwinding the liability by 1, which is 10% of $10 million, is the amount of unwinding. Yes, Simran, the insurance cost would be expensed off if it relates to 1 year, and if it relates to more than one, then will be capitalized separately. If the insurance relates to more than a year, that would be capitalized separately. Yes, Muhammad Nabil, that will not be a part of the asset. Okay, now what will be the entry for unwinding and depreciation? Now what will be the entry for unwinding and depreciation? Let me write over here. I'm writing the second entry. The first was asset debit, provision credit. The second entry is depreciation expense debit and the asset being credited. And the third entry, the unwinding entry, is actually finance cost debit, and provision for dismantling credit. So this will actually increase the provision for dismantling by $1 million. So the unwinding is actually always recorded in the finance cost. Unwinding is always recorded in the finance cost. So 3 steps: PP debit, provision credit, asset debit, provision credit, depreciation expense debit, asset credit, finance cost debit, provision credit. These are the 3 entries that you have to remember for the dismantling cost. Now let's have a past papers question, and you people have to answer it. Which of the following should be capitalized in the initial carrying amount of the item of plant? This is actually a past paper question relating to section number A. So this is a past paper question, and the question is asking which of the following should be capitalized in the initial carrying amount of the item of plant. The initial word is very important, that according to initial measurement, initial recognition, what should be capitalized. So the cost of the transporting of the plant to the factory, cost of installing a new power supply required to operate the plant, cost of a 3-year plant maintenance agreement, and 3-week training course for staff to operate the plant. Now you have to answer correctly. Okay, Hafsa Ahmad is saying B, Talal is saying B, Ayaz Ali B, Hamza B, Hafsa B, Hamza B, Sami B, Nazia B, a lot of B, 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 B. Okay, yes, the answer is correct. The answer is B. Because the cost of transportation is a directly attributable cost, and without transporting the plant to factory, we cannot use it. Without transporting, we cannot use it. And without a power supply, we cannot use the asset. So if we are not giving the tablet a power supply, how can we use it? The cost of 3-year maintenance agreement, this is something else. This will be treated as a separate asset. This is an asset, but a separate asset. The cost of this maintenance contract will be capitalized for 3 years and depreciated over 3 years, but this will not be a part of the asset. And training is obviously, we have already discussed this, the training cost is not being capitalized. Thank you, Ayaz. Okay, now one more question for you people. Now the question says that on 1st October 20x4, Caletra company commenced drilling for oil from an undersea oil field. There is an oil field beneath the sea and we are exploring drilling for the oil, and Caletra company is required to dismantle the drilling equipment at the end of its 5-year license. So after the exploration of the oil, we obviously have to remove our plant. We obviously have to remove our equipment that we have installed. This has an estimated cost of $30 million. So $30 million is the dismantling cost. On which date? On 1st October 20x4, we have commenced the drilling. So this had an estimated cost of $30 million on 30th September 20x9. So is this a present value or a future value? Is this $30 million a present value or a future value? Yes, this is a future value. Nazia, this is not present value, this is future value. Yes, everyone is saying correct almost. This is a future value because this is the value that we are going to pay on 30th September 20x9. Now the question says that Caletra company's cost of capital is 8% per annum and $1 in 5 years time has a present value of 68 cents. So the question has already given us the discount factor. So the present value is going to be $30 million into 0.68. This is going to give us the present value. So if I run a calculator, I'm going to say 30 into 0.68 is going to give us a balance of 20.4. So 20.4 million is the present value on 1st October 20x4. Now the question is said that what is the provision which Caletra company would report in its statement of financial position at 30th September 20x5. This date is very important because the question is asking the provision, the value after 1 year. After 1 year, so we actually need to unwind it for 1 year. We actually need to unwind it for 1 year. So if I'm going to unwind it, I'm going to write unwinding with this. And the unwinding will be 20.4 into 8%. So 8% of 20.4 is going to be 1.632. So I'm going to add 1.632. So this would become 22.032. So your answer is actually B. B is the answer, $22.032 million. This is the provision that should be recorded. Nazia, it's not D. You have to add the provision. You don't have to deduct it, you have to add it. Okay, thank you everyone for informing the values. So the answer is actually B. And let's suppose I'm writing down now the complete accounting so that you are aware if the question would have asked something else, you would have known. So now I'm writing the complete accounting. So I'm writing all of the 3 entries. So the first entry that we are going to prepare is property, plant and equipment debit and the provision for dismantling credit by 20.4 million. This is the present value that we have capitalized, present value capitalized. And then if I'm going to depreciate the asset, the life was 5 years. So if I'm going to depreciate it, I'm going to say depreciation expense debit and the property, plant and equipment credit by 20.4 divided by 5. 20.4 divided by 5, which is going to be 4.08. So the depreciation would be 4.08. And then the third entry is actually finance cost debit and the provision credit that we have already calculated, 1.632. So if I write down the values that would be reported in P&L, if I write down the values that would be reported in P&L, I'm going to say the depreciation expense is a part of P&L by 4.08 and the finance cost is 1.632. So the total is going to be 5.712 in P&L. So the question can even say, if I change the requirement and I say, calculate the amount that would be recorded as an expense in P&L. Calculate the amount that would be recorded as an expense in P&L, so that would be 5.712. So actually the objective is not to only solve the past paper question, but to see what else the question can ask. This is the past paper question, but apart from this, what else the question can ask? The question can ask you the total expense in P&L. The question can ask you to write down the value of the property, plant, equipment in the balance sheet. So the value in the balance sheet is going to be 20.4 minus the depreciation of 4.08. So the asset will be recorded at 16.32. This is the value of the asset. And similarly, the question can ask you the value of the provision in the balance sheet, which was 22.032. So actually the question has asked the amount of the provision, this one, but the question could have asked the value of the property, plant, equipment of 16.32. The question could have asked the depreciation expense of 4.08. The question could have asked the total expense to be recorded in P&L, which was 5.712. So the question can ask any, the question can write down any of the requirements. You should be aware of solving all type of values. Umni is asking that, so if they don't specify which provision, no, Umnia, the question has already specified the provision. The provision which would be reported in the balance sheet at the year end. The question has completely informed the value which is required. Okay, Mariam Bukhari is asking that after completing this question, can you give us 2 minutes to review the question? Mariam, you can simply take a snapshot of this. You people have access to take the snapshot. Take a snapshot. It will be saved on your PC and review it as many times as you want. If there's any question, you can post it on the WhatsApp group. People will be there to answer you. Bilal Tar is asking if the cost of equipment was on present value, then what will be the amount in P&L? Bilal, whatever is the present value, 8% of that is in P&L. Dhyani is asking, can you please tell the unwinding of second year? Okay. Simran, I have already written the double entries. The provision credit by 20.4 and the provision credit by 1.632. That's why we have added it. Okay, now there's one question that what will be the finance cost of year 2? What will be the finance cost of year 2? Simran, this is year 1. Simran, this is year 1. Every entries are done in the year 1. Simran, every entry that I've written for 1, 2, 3 relates to year 1. But now my question is that what is the unwinding for year 2? Neeraj is saying 1.6256. Okay, seems correct to me. So in year 2, basically we are going to calculate 8% of 22.032. So if the question asks you the provision finance cost for year 2, so this will be 22.032 into 8%. So this is 1.76256. So yes, your answer is correct. Yes, Nazia, your guess is correct. Hamza Ahmed, Wahid, Lee, Neeraj, all of you are correct. That's good. So this is how we have solved the first question. And now let's move further. We are moving towards the depreciation. And I think we are running short of time. We are already 1 hour past. So I had calculated the time of on an average 5 minutes per slide. So we should have been at 20th slide up to now. So let's move further a bit quick. I would take your questions comparatively less so that at least we are able to complete the target. And then all of your questions can be there on the WhatsApp group. do ask over there. I will be there to answer you. So now we are calculating the depreciation. There are two depreciation methods, straight line method and the reducing balance method. In the reducing balance method, the depreciation is calculated as net book value into the percentage. Net book value into the percentage. But if the question is a straight line method, there may be either a percentage or maybe a life. If the question has given you the percentage, depreciation is cost into the percentage. So you have to check the percentage either relates to straight line or to the reducing balance. If it is reducing balance, net book value into percentage. If it is straight line, cost into percentage. So do check the depreciation method before applying it. And if the question has given you life, there can be three lives: the total life, the remaining life, and the age. Total life, remaining life, and the age. If the question has given you total life, the depreciation is cost minus the residual value divided by the total life. Cost minus the residual value divided by the total life. And if the question has given you the remaining life, then you are going to use the net book value. Net book value minus residual value divided by remaining life. So you have to see in the question if the question is giving you total life or the remaining life. Then you have to decide whether to use cost or to use the net book value. And if the question has given you age, the age means the life already used. The age means the life that we have already used. So if the question gives you the age, so then the accumulated depreciation divided by age will give you the depreciation. Yes, Bilal, net book value means the carrying value. Net book value means the carrying value. Okay, so now I've discussed three different lives: total life, remaining life, and the age. And one thing more that you have to remember, that for a revalued asset, depreciation is fair value. Fair value, this is not future value, this is fair value, minus residual value divided by remaining life. For revalued asset, there is no other way to calculate the depreciation. You have to solve it in this way: fair value minus the residual value divided by the remaining life. Dania wants to understand the age again. Dania, age. If I ask you your age, you are going to tell me the years that you have already lived. So age means the years already passed by. So if I say this pen's age is 2 years, so this means I've used it for 2 years. If the tablet's age is 5 years, I have used it for 5 years. Okay, Bilal is saying sum of digit method, machine hours. Bilal, those are not that important. Okay, Benedicta is saying that she cannot hear my voice. Is everyone else able to hear? Is everyone else able to hear me properly? Yes, 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 yes. Okay. So Benedicta, I think that you should try to restart the session from your side, because there is something from your side. Okay, now, so we are done with the depreciation. Now, two more small points that you have to remember. That what is a depreciation? It is a systematic allocation of the cost over the useful life, reflecting the pattern of use. This is not or, this is of use. So what is depreciation? Depreciation is a systematic allocation of the cost over the useful life, reflecting the pattern of the use. So if the pattern of use is same each year, this would result in a straight line depreciation. And if the benefit is reducing each year, we would move towards the reducing balance method. And second, that you have to review annually. An annual review is required with the change treated as a change in estimate. So the depreciation methods, the life of the asset, the residual value, all of these should be reviewed annually. All of these should be reviewed annually with any change in the life, the residual value or the depreciation method. All these changes are treated as a change in accounting estimate. No, Bilal, I haven't heard anything about him. Is there any specific thing that you do that you want to tell? Okay, Simran wants to listen. Three things again. Three things that we have to annually review: the life, the residual value, and the depreciation method. By annual review, we mean the life. You have to review the life annually. You have to review the residual value annually, and you have to review the depreciation method annually. All these three things should be reviewed annually, with any change accounted for prospectively. Okay, Dania wants the revaluation point again. Zuhaib, revaluation entry we are going to discuss later. Revaluation point is that that if an asset has been revalued, we are going to use the fair value, not the future value, fair value of the asset minus the residual value, and then dividing by the remaining life. We cannot use the total life or the age for a revalued asset. We cannot use the age or the total life for the revalued asset. For revalued asset, we have to use the remaining life only. Kohli, the change in accounting estimate is treated prospectively. Now there is one more past paper question. This time I want you people to try it on your own. Read the question, go through this, and then tell me the answer that you think is correct. Okay, Bilal Tariq is saying B. What about the others? Always remember you have to read the question very carefully. Very carefully. Sometimes we have the knowledge, but we make errors. So having knowledge is not enough. Reading the question properly, attempting it in the right direction is very important. Muhammad Zuhaib is saying A. Umnia is saying A. Okay, let's solve it now. The question says that Tibet acquired a new office building. This is a new office building on 1st October 2014. This is the purchase date. And the question wants me to write the value on 31st March 2015. The question is saying at what amount will the office building be shown in Tibet's statement of financial position? So we want to write down the net book value on this date. So which means that how many months have passed by? October, November, December, January, February, and March. 6 months. So we are talking about 6 months time duration. Now the land had a cost of 2,000. Land normally is not being depreciated. The building structure is of 10,000 and the air conditioning system is of 4,000. So the total is 16,000. The estimated lives of the building structure and the air conditioning system is 25 years and 10 years respectively. So the building structure is of 25 years and the air conditioning is of 10 years. When the air conditioning system is due for replacement, it is estimated that the old system will be dismantled and sold for $500,000. So to calculate the depreciation of the air conditioning system, the cost of 4,000 minus 500 divided by 10 years is going to be the depreciation. Depreciation is time apportioned where appropriate, which means that we are going to depreciate for 6 months only. So 6 by 12 and 6 by 12. This is going to be your answer. So if I use the calculator, I would say that 10,000 divided by 25 years is 400, and 400 into 6 by 12 is 200. So the building is basically depreciated by 200, and now I'm calculating the depreciation of air conditioning. 4,000 minus 500, depreciable amount is 3,500 divided by 10 years. Annual depreciation is 350 into 6 divided by 12 is going to be 175. So the total depreciation is 375. So the net book value is going to be 16,000 minus 375, which is going to be 15,625. So your answer is actually A. Your answer is A. So you actually have to calculate the depreciation properly. If you're making mistake, for example, people tend to forget deducting the 500. We have just discussed cost minus residual value divided by the remaining life or the total life if the cost is being used. So the answer is actually A, 15,625. Again, this is a past paper question. All of the questions that we are going to solve in this revision session will be of past papers. So I have not created any question other than where I've written example, such that I will be solving for examples as well. Now let's discuss the accounting for revaluation. Now in subsequent measurement, after initial measurement, we can either carry the asset at cost model or we can either carry it at the revaluation model. In revaluation model, we are going to carry this asset at its fair value, and at cost model, we are going to write it at cost less the depreciation. So in the fair value revaluation model, this will be fair value less depreciation. Fair value less depreciation, and the cost model, this will be cost less depreciation. So cost less depreciation, and in this fair value movement is completely ignored. We are not going to record any fair value movement, whether it's an increase or a decrease. We are completely going to ignore the fair value movement. But in revaluation model, when we are revaluing the asset to its fair value, this would either result in a gain or would result in a loss. The gain would increase the asset being debited, and the gain will be recorded in revaluation reserve through other comprehensive income. So revaluation reserve through OCI. Ali, we are not also going to record the loss in the cost model, whether it's a gain or a loss, completely ignore this. And in revaluation model, if there is a loss, the asset will actually decrease and the loss will be recorded in P&L. So if there is a gain, OCI, if there is a loss, P&L. And if there's a gain, so after gain, we also transfer the excess depreciation, but this is optional. Optional for the students? No. Optional for the company. The examiner will guide us in the question whether we have to transfer or not. This is not an option for the student. This is an option for the company. If the company wants to transfer the excess depreciation, they can. And if they don't want to transfer the excess depreciation, still they can. So this is an optional entry, but not for the student. So sometimes the examiner would say transfer the excess depreciation or not transfer the excess depreciation. If we are transferring the excess depreciation, we are going to debit the revaluation reserve and we are going to credit the retained earnings. We are going to debit the revaluation reserve and we are going to credit the retained earnings. So we are actually transferring the excess depreciation from revaluation to retained earnings. And if we have a loss after the gain, the asset will be credited because of the loss. The loss will first be recorded in the revaluation reserve through OCI up to the amount remaining over there. Now let's suppose that the asset was revalued upwards by 100 and the excess depreciation transferred is 10. So now the remaining amount in the revaluation reserve is 90. So if the loss is of 150, the excess of 60 is going to be recorded in P&L. But the P&L will only be recorded by the excess amount and not for the remaining amount. Yes, Simran, we are actually deducting the loss over here. So whenever there is a loss, direct loss, P&L. When there is a direct loss, P&L. When there is a gain and then a loss, when there is a gain and then a loss, first we are going to remove the revaluation reserve and then we are going to record the remaining loss in the P&L. Okay, Mohammed Nabil is saying equity portion. Nabil, we are right now discussing the entry simply, and then we are going to discuss the overall impact as well. Okay, Simran. Now I'm repeating the transaction again. If there is a loss after the gain, first we had a gain and now we have a loss. First we had a gain, now we have a loss. So we have already recorded a revaluation reserve by 100 and we have transferred the amount of 10. Now the remaining amount is 90. So if the loss is of 150, the reserve will be of 90 and the remaining amount will be of 60. The remaining excess amount will be recorded in P&L. Okay, we will be solving a question as well, an example as well. So if any one of you are not able to understand in this screen, no problem. We are going to understand it in the next screen. Now the next thing is that if there was a loss and we have recorded the loss in P&L, we have recorded the loss in P&L and now there is a gain. A gain after the loss. Now what will we do? If there is a gain, the asset will be debited, increased asset debit. And first we are going to reverse the loss recorded in P&L. First we are going to reverse the loss that was already recorded in P&L, and then the excess amount will be recorded in revaluation reserve through OCI. The excess will be recorded in revaluation reserve through OCI. So for example, the asset was revalued downwards by 100, resulting in a loss. And now the asset is revaluing upwards by 100. So first we are going to credit the P&L and then the excess will be taken to the OCI. So if there was a gain in OCI, first reverse that, then record a loss. If there was a loss in P&L, first reverse that, then record a gain. So whenever there's an opposite movement, gain after loss or loss after gain, gain after loss or loss after gain, we are going to first reverse the previous impact recorded and then record the new impact. First we are going to reverse the previous impact and then we are going to record the new impact. And the last point that we have to remember, that the revaluation is required with sufficient regularity so that the carrying amount does not differ materially. This means that it is not necessary to revalue the asset at each year. It is not necessary to revalue the asset at each year. You have to revalue it with sufficient regularity that it does not differ materially. You have to revalue with sufficient regularity that it does not differ materially. This is something which can be asked theoretically in section A MCQ. Now let's have an example. Let's have an example. We have an upwards revaluation and then we have a downwards revaluation. This is not a past paper question. This is one of my own example questions. So the question says that there's an asset with a cost of $100 million. The life of the asset is 10 years and the fair value at the first year end was 108 and at the second year end was 60. Okay, sorry. So now let's start the answer. Let's start the question. The cost of the asset was 100. The depreciation is going to be 100 divided by 10 years, which is going to be 10, and the net book value is actually 90 before revaluation. Now the question says that the fair value was 108, which means that the gain recorded in the first year is going to be 18. So this gain will be recorded in revaluation reserve through OCI because this is a first time gain. Now the asset is at 108. So the new depreciation is going to be 108 divided by 9 years. 108 divided by 9 years, which is going to be 12. So after charging the depreciation of 12, the net book value is now 96. And the question has said that the fair value was now 60. This means that there is a revaluation loss of 36. Now, what will be the entry of 36 is that the property, plant, equipment will be credited by 36. First, we are going to reverse the revaluation reserve through OCI, and then the excess is going to be taken to P&L. The excess is going to be taken to P&L. Thank you, Shazeb. Now, what amount will be recorded in the revaluation reserve? Now, this depends on whether we are transferring the revaluation reserve to retained earning or not. So if no excess depreciation is being transferred, the revaluation reserve will be 18 and the remaining excess balancing figure is going to be recorded in P&L of 18. If no excess depreciation is being transferred, then this is going to be the entry. And if the excess depreciation is transferred, in that case, the revaluation reserve would have been debited and the retained earning would have been credited. By what amount? By the amount of excess depreciation, which was 2. Before revaluation, the asset was being depreciated by 10, and after revaluation, the asset is being depreciated by 12. So the excess depreciation is 2. So once the amount of 2 has been transferred, the remaining amount would become 16. So the entry would become property, plant and equipment credit by 36, revaluation reserve through OCI debit by 16, and the excess being recorded in P&L by 20. So this is the entry if we are transferring the excess depreciation, and that is the entry if we are not transferring the depreciation. Dania is asking how revaluation reserve is 18. Dania, here we have calculated the revaluation reserve. Let me highlight it for you. This is the value of 18. The asset which was revalued from 90 to 108, 18. Okay, so are we all clear on this? Is every one of us clear on this? Okay, that's good. Thank you. Now let's continue with another example. Now this time I would want you people to solve this example on your own. Syed Maz wants to repeat the excess depreciation. Maz, the excess depreciation is basically old depreciation minus the new depreciation. Excess depreciation is the old depreciation minus the new depreciation. Bilal is saying difference between net book value and NRV. Bilal, these are two very different things that you are asking, net book value and the NRV. Dania wants to take a snapshot of the previous slide. Here you go, Dania. Yes, Sheikh Saqib, we will be taking the break after this example. So the 3 hour session will be divided into two, 1.5, 1.5, and a 10 minutes break between these, so that you people can rest, have something to eat, something to drink, obviously. So a person cannot focus beyond 1.5 hours. So we will be taking the break. So let's solve this question and then we will be moving towards a 10 minutes break. So now this time downwards and upwards revaluation. So the cost is 160, life is 8 years, fair value 112, fair value 115. So if I calculate the cost, I would say it is 160. The depreciation is 160 divided by 8 years, which will become 20. So the net book value was 140. Then the fair value informed by the question is 112. So this means that there is a revaluation loss that would be recorded in P&L by 28. A loss of 28 recorded in P&L. And now the new depreciation is going to be 112 divided by 7 years. So 112 divided by 7 years is actually 16. So after charging depreciation of 16, this would become 96. 96 is the net book value when the fair value has now increased to 115. So the increase is of actually $19 million. The increase is of $19 million. So now the entry is going to be property, plant, and equipment debit by $19 million. And the loss was actually 28. The loss recorded in P&L was 28. Now the gain is beneath the loss. So what we do, we simply credit the P&L by 19. If the revaluation gain instead of 19 would have above 28, then there would have been some excess, but right now there is no excess. So the entry is 19, property, plant, equipment debit, and P&L credit. So if there is any confusion you people can ask, then we will be moving towards the break. Any questions so far? Although we are moving a bit slow because 20 slides were planned in an hour, but we have passed 1.5 hours. But don't worry, your preparation is our top priority. And yes, Ray, today is the first lecture. Okay, so now let's take a 5 minutes break. Sorry, 10 minutes break. And right now with me, the time is 11:31. So we will be taking the break till 11:41. So let's start the break and meet you after 10 minutes time. Okay, everyone, welcome back. Meanwhile, there are a few questions. Harsh is saying, so if revaluation gain was 30 instead of 19, the excess of 2 million would be, yes, exactly. Yes, exactly, Harsh, you are right. You have got the point correctly. Now let's move further, and we are solving a past paper question MCQ now. The question says that the following trial balance extract relates to property which is owned by Wheaton at 1st April 2014, and the question requirement relates to something in March 15, which means that this is a complete year. Always check the year end because it is necessary that the value being asked relates to which date. What will be the depreciation charge in Wheaton's statement of profit or loss for the year ended 31st March 2015? So now the question says that the property at cost was 12,000 and the original life, which means the total life, was 20 years. Accumulated depreciation at the start of the year was 3,600. And on 1st October 2014, which means April, May, June, July, August, September, 6 months down the line, which means exactly mid of the year, following a sustained increase in property prices, Wheaton revalued its property to 10.8 million. So we are actually revaluing the property in the mid of the year. So this means the depreciation in the first 6 months would relate to before revaluation, and depreciation in the next 6 months would relate to after revaluation. So now let's calculate the depreciation. So 12,000 divided by 20. Depreciation is going to be 12,000 divided by 20 will become annual depreciation into 6 by 12 is going to give us a depreciation of 300. $12,000 divided by 20 into 6 divided by 12 is 300. So the depreciation of first 6 months is actually 300, and the net book value on this date is going to be total depreciation of 3,900. 12,000 minus 3,900 is actually 8,100. So the net book value is 8.1. So the asset is being revalued by 2.7 million, but this is something not asked by the question. We have just calculated so that you people are aware of how we are going to calculate these values. Now the new depreciation is going to be 10.8 divided by remaining life. Now what is the remaining life on this date? Can someone tell what is the remaining life on this date? Okay, Cooley is saying 13.5, Harsh is saying 13.5, Hamza Ahmed is saying 14. What about the others? Sheikh Saqib is also saying 13.5, Lee is saying 19.5. Okay. Yes, the answer is 13.5. Because if we see, the total depreciation charge is now 3,900. And the annual depreciation was actually 600. The annual depreciation was 600. So if I divide 3,900 by 600, I'm going to get the age. If I divide 3,900 by 600, I'm going to get the age, which was 6.5. So the asset is being already depreciated by 6.5 years. So out of 20, remaining life is 20 total life minus the age of 6.5, which will give us the remaining life of 13.5. So the remaining life is 13.5 and the depreciation is going to be 10.8 divided by 13.5 into 6 by 12. So 6 by 12, so that only 6 months depreciation is calculated. So 10.8 divided by 13.5 into 6 divided by 12. So this is 0.397 million. So we are calculating in thousands. So this would become 397, which will become approximately 400 because no values are there in the decimals. So the total depreciation in this case would become 700. So your answer is actually C in this part. So the answer is also C. Any confusion in this? 300 for the first 6 months and 400 for the next 6 months. Okay. So now let's discuss the rules for derecognition. Now let's discuss the rules for derecognition, that how the asset should be derecognized from the financial statements. So first, let's discuss the correct entry for derecognition. The entry is bank debit by the amount of the sale proceeds that we have received to sell an asset. Asset being credited by its carrying amount or the net book value, and P&L is the balancing figure which can be debit or which can be credit, both. So bank debit by the sale proceeds, assets credit by the net book value, and the balancing figure is the gain or loss on disposal. Sayyid Mazullah wants to see the last slide. Maz, quickly take the screenshot. Smitha is asking what is 2.1 million? Smitha, 2.1 million. Where I've written 2.1? Have I written 2.1 somewhere? Cannot find. Smitha, which 2.1 are you asking? Okay, it's 2.7. 2.7 is the amount of the revaluation gain that would have been taken to OCI, but that is not being asked by the question. Okay, so now let's see an example for this. The question says that revenue includes $80 million for a plant sold during the year. We have sold a plant and we have recorded the amount in the revenue, which means the question has actually debited the bank by 80 and credited the revenue by 80, which is an incorrect entry. Disposing of plant is not a revenue. The plant had a cost of $100 million and was depreciated by $30 million. So the net book value was actually $70 million. The plant is still included in the trial balance. The question says that the plant is still included, which means that this is the only entry prepared by the question. And the correct entry should be bank debit by 100. The correct entry should be bank debit by 100 and plant credit by 70 and the gain on disposal being recorded by 30. Now this is the correct entry and this is the incorrect entry. This is the correct entry and this is the incorrect entry. Now how we are going to record the correcting entry is the bank has been correctly debited by the question. We have no issues with this. So the correcting entry is going to be revenue debit by 80. Okay, I'm sorry, this is not 100, this is 80. And this is not 30, this is 10. Because the revenue received was 80. So we are going to debit the revenue by 80, we are going to credit the plant by 70, and then we are going to take the balancing figure of 10 as a gain on disposal. So this is how the gain on disposal should be calculated in this case. Imran Anis is saying, what is OCI? Imran, OCI means other comprehensive income. OCI means other comprehensive income. Okay, Harsh is saying, by the balancing figure in the journal entry, do you mean profit or loss on disposal? Yes, exactly. By balancing figure, we mean the remaining amount. The remaining amount. So if debit is 80, credit is 70, the remaining amount is a credit of 10, which is a gain or loss on disposal. Okay, so if I change the question a bit and if I say that the net book value of the plant has been transferred to cost of sales, this time the incorrect entry would change, and this would mean that the question has recorded an entry as bank debit, revenue credit, same by 80, and the net book value has been transferred to cost of sales, which means that the question has debited the cost of sales by the net book value of 70 and credited the plant by 70. Now this is the incorrect entry recorded by the question. And what was the correct entry? The correct entry was bank debit by 80, plant credit by 70, and balancing figure of gain being recorded by 10. So this is the correct entry and this is the incorrect entry that has been recorded. So now the bank has been debited correctly. The plant has been credited correctly. So now the correcting entry is going to be revenue debit by 80, revenue corrected, cost of sales credit by 70, cost of sales corrected, and then the P&L balancing figure being recorded by 10, P&L corrected. So this is the correcting entry that the students will be expected to write in the exam in this case. So this is how normally the D recognition question can be asked. Either both of them will be recorded, revenue and cost of sales, or only the revenue will be recorded by the question and you will be expected to write the remaining transaction. Now we are going to discuss IAS 23 borrowing cost. The first thing is, what is borrowing cost? What is the concept of borrowing cost? Borrowing cost is a directly attributable cost. For example, if I'm manufacturing a plant, if I'm developing a self-constructed asset and I don't have any amount for that. I want to construct an asset but I don't have any amount. So what would I do? I will take the loan from the bank and pay interest on that to construct the asset. I will take a loan from the bank, pay an interest to construct the asset. Now the interest payment, is it a directly attributable cost? Yes, because without this payment we cannot develop the asset. So the interest cost would also become the directly attributable cost for the asset and therefore is capitalized for qualifying assets. Now what are qualifying assets? This is something else. Let's understand the remaining part. That if I want to construct this machine, I don't have amount, I don't have cash, I go to the bank, take a loan and and I construct the machine. Now to construct the machine, I need to pay the interest. Apart from the material, labor and overheads, I also have to pay the interest. So the interest cost will also be capitalized, but only for the qualifying assets. Now what is a qualifying asset? Qualifying asset means an asset that necessarily takes a substantial period of time to get ready for its intended use. So qualifying asset is an asset that takes a substantial period of time. Now the substantial period of time is not defined in terms of 1 year, 2 year, 5 year, 12 months, 6 months, 8 months. No. Substantial period means any period in which the amount becomes material. Substantial period means any period in which the amount becomes material, which is normally a year or maybe 6 months or maybe 3 months depending on the amount. So qualifying asset is an asset which necessarily takes a substantial period of time to develop or to bring into the intended use. Sayyid Saad Farooq is saying an example for this. Saad, an example is this, that for example you are making an office. You have purchased a land and now you want to make an asset, your office on that, but you don't have any amount. So you go to the bank, take a loan, construct an office and pay the interest. So the office would obviously take a substantial period of time to build. It is not possible to build the property in a day or two. It will take a substantial period of time. Now, what is the accounting? The first thing is that you have to calculate the borrowing cost. How do we calculate the borrowing cost? That the cost that will be capitalized is equals to cost incurred. The cost, by cost we mean interest. Or I would say it's better to write interest incurred less any interest income. If we have temporarily invested the amount somewhere and we are gaining the interest income on that, so the interest that I'm paying to the bank minus the interest that I'm receiving from someone. The interest that I'm paying to the bank minus the interest that I'm receiving from someone. So if I've taken the loan of $10 million from the bank, obviously I would not have invested 10 million immediately. If I've received a loan of $10 million from the bank, obviously I will not invest $10 million immediately. I would invest 1 million and then 1 million and then 0.5 million and then 2 million and then 3 million. The remaining amount will be invested somewhere. The remaining amount will be invested somewhere to earn the interest income on that. So the income that I'm receiving and the interest that I'm paying, the net amount is my cost. I'm paying 1 million interest, I'm receiving 0.2 million interest. I'm paying 1 million interest, I'm receiving 0.2 million interest. So the net interest is of 0.8. So the interest to be capitalized is 0.8, the net interest that I've paid. The net interest that I've paid. So now, what is actually cost incurred? While calculating the cost incurred, capitalization should start when the cost is being incurred. Capitalization will start when the cost is being incurred. So for example, I've taken the loan on 1st January. I've taken the loan on 1st January, but the construction starts from 1st March. I've taken the loan from 1st January, but the construction starts on 1st March. So the capitalization will start from 1st March. From when we have started to construct the asset, not from when we have taken the loan. The capitalization will start from when we have started to construct the asset and not from when the loan has been taken. Secondly, suspend when the development is stopped temporarily. So for example, we have taken the loan on 1st January, but we started the construction on 1st or 31st March. And then on 30th June, we have temporarily stopped the construction. And we have resumed on 30th September. We have resumed on 30th September. So this time the development has been stopped. So for this 3 months, July, August, September, the interest will not be capitalized. And for January, February, March, the interest will not be capitalized. Not capitalized in this, not capitalized in this. According to the first point, according to the second point. And if the construction has been completed on 30th November, if the construction has been completed on 30th November, the capitalization would cease on this date. So ceased when the development is completed. So after this, no interest will be capitalized according to the third bullet. So capitalization will start from when we have started the construction. Capitalization will start when we have started the construction, will end when we have ended the construction. And if we have temporarily suspended the construction, stopped the construction for the temporary period, during that time the interest will also not be capitalized. Dung Nigo is asking that if the interest income is higher than the interest expense, then nothing will be capitalized. Smita is saying you said substantial period is any period in which amount becomes material. Smita, material. Material means something that matters. Substantial period is the time when the amount becomes material. Fawad is saying if such asset occurs under IES 2, then we should include interest cost in such asset or not. Yes, Fawad, you will include such interest in inventory as well. Irrespective of the type of the asset, the interest cost will be capitalized because it is a part of the cost of the asset. Simran is saying, sir, should it be development or construction? It is the same, Simran. It may be development, it may be construction, means the same. Simran again is saying, if sir, for temporary investment income, should we take into account when the construction begins or when we start investing? No, you can simply deduct the entire investment income. Simran, you can simply deduct the entire investment income. Harsh is saying for investment income, should we record the investment income only after construction? Same question, Harsh. You will deduct the entire interest income, even if we are earning from January to March or during June to September, you will simply deduct that also. Okay, now let's discuss the interest rate. Now there are two types of loan, a specific loan and a general loan. A specific loan and a general loan. So if so the specific rate is used when the borrowing is specific. If I have borrowed specifically for this asset, then the specific rate will be used. But if it is a general borrowing, I have borrowed a lot of loan for many of the things and I've just taken an amount from there to construct the asset. I have a lot of loan and I'm using that loan for different purposes. There are 4 or 5 different loans and now I'm using an amount from that. So what we do, that we are going to calculate a weighted average rate and we are going to use that in case of a general borrowing. So for example, if I've taken $10 million loan on 8% and I've taken $15 million of loan on 6% and I'm using an amount from this, so what will be the weighted average rate is the interest on both divided by the amount on both. Interest on both divided by the amount of both. So the interest is going to be 10 into 8%, which is going to be 0.8. And 15 into 0.6 is going to be 0.9. So this would become a total of 1.7 for $25 million of loan. So the general borrowing rate, the weighted average rate is going to be, let me check the interest as well, 15 into 6% is 0.9, okay. So the general borrowing rate is going to be 1.7 divided by 25 into 100, which is going to be 6.8%. So 6.8% is going to be the weighted average rate that we are going to use for general borrowing. So if we have a general borrowing, we have to calculate the weighted average rate. Okay, Cooley is asking again a question. Real life, we don't capitalize cost that are in work in progress or inventory for network activities. What is the main rationale behind capitalizing the borrowing cost? Why don't we include the work in progress, Cooley? We do include the work in progress cost in the inventory. There's no harm in that because the cost that we are incurring for the inventory should be capitalized. Okay, so I'm repeating the weighted average rate again. If I've taken a $10 million loan on 8% interest and a $15 million loan on a 6% interest, and this is a general loan, this does not belong to any specific item, then what do? We calculate the amount of 0.8 on the first loan, 0.9 on the second loan, total interest of 1.7. So the weighted average rate is going to be 1.7 divided by 25, which is giving us 6.8%. So this is how we have calculated 6.8. Total interest of 1.7 divided by total amount of 25 is the weighted average rate. Total amount of interest divided by total amount of loan is the weighted average rate. So if you people want a formula for the weighted average rate, I would say total interest divided by total amount into 100. Total interest divided by total amount into 100 is the amount of the loan. is the amount of the weighted average rate. So now there is again a past paper question, MCQ. Let's try this. You have to try it on your own and provide me the answer that you think is correct. Read the question and try it on your own. Okay, Simran is getting B. Kuli is saying my question comes as a result of the tower construction. If we are constructing and the tower hasn't been commercialized, then why we are capitalizing the borrowing cost? Kuli, we will start capitalizing the borrowing cost once the construction has been started. So if you haven't commercialized it yet, for example, it's not on the commercial plot, then the interest will not be capitalized. Okay, a lot of people are getting B. Yumna is saying B. Ulawale is saying B. Ahmed Ali B. Fawad B. Wafa B. Hamza Ali D. B. B. Okay, let's see. Let's calculate now. The question is asking what is the carrying amount of the production equipment in Bash Company's statement of financial position as at 30th September 20x2. The question says that on 20x1, which means 1 year back, Bash borrowed $6 million for a term of 1 year exclusively to finance the construction. This means that this is a specific loan. And we have taken amount of $6 million for 1 year. Of a new piece of production equipment, the interest rate on the loan is 6% and is payable on maturity of the loan. The construction commenced on 1st November 20x1. So on 1st October, we have borrowed, but the construction has started from 1st November. So from when are we going to capitalize? From 1st November only. So 1 month not capitalized. But no construction took place between 1st December to 31st January, which means December and January, 2 months again. So the first month was not used, 2 months stopped, so 3 months will not be capitalized in total. Due to employees taking industrial action, the asset was available on use on 30th September 20x2 and has a construction cost of 6 million. So 6 million into 6% into 9 by 12. Why 9? Because we have excluded 3 months. October month excluded because the construction has not yet started. December, January excluded because the construction was suspended temporarily. So removing that would become a total of, I'm running a calculator again. So this is 6 million into 6% into 9 divided by 12 is 0.27. So this is the amount of the interest that is going to be capitalized. Now the question was asking the value of the production equipment. So the cost was 6 plus the borrowing cost 0.27 is going to be $6.27 million. So the answer is B. You people are correct. So this is the answer. So I hope the past papers questions are not too difficult that one can say that these cannot be attempted at the student level. No, In fact, I would say these are comparatively easier. The examiner can even go beyond this. The examiner would have asked a general rate in this case, and then you people would have answered that. There is no interest income in this case. There's no general borrowing rate. There is the construction would have been completed at before the year end. So all these things are not being examined in this question. Okay, now let's discuss IAS 40. With this, we will be ending the first topic of tangible non-current assets, and then we'll be moving towards IFRS 9, and then we have IAS 12. If we are unable to complete all the tasks today, we will continue from the same place tomorrow. If we are unable to complete today, we will complete from tomorrow from the same place where we have left. Okay, now investment property. The first thing is the scope that we have already discussed, that the objective is to earn rentals or capital appreciation, and if the intention is unidentified, even then we are going to classify in IAS 40. But one thing that we have to remember, IAS 40 will only include the properties. By property, we mean the land and the building. By property, we mean the land and the building. Nothing else can come in IAS 40. No plant, no equipment, no intangible, nothing else. Only land and your building. Now, what is the accounting? We have two accounting methods, a fair value model and a cost model. In cost model, this is the same as IAS 16, that we are going to carry at cost less depreciation, and we are going to ignore any fair value movement. If the fair value increases, we are going to ignore it. If the fair value decreases, we are going to ignore it. Fair value increase, ignore. Fair value decrease, ignore. But in fair value model, we carry the investment property at fair value, and all gains and losses are recorded in P&L. This is unlike IAS 16. This is something different than IAS 16. In IAS 16, we used to record the gain in OCI and the loss in P&L. In IAS 16, we used to record the gain in OCI and the loss in P&L, but in IAS 40, the gain and the loss, both will be recorded in P&L. In IAS 40, the gain and the loss, both will be recorded in P&L, and no depreciation will be charged in this case. Again, something different than IAS 16. Again, something different than IAS 16. And the third difference is that you have to revalue this property at each year end. You have to revalue the property at each year end. In IAS 16, we said that you have to revalue with sufficient regularity. But in this case, you have to revalue at each year end. There is no rule of sufficient regularity in this case. You have to revalue at each year end. So this was a simple IAS 40. If you people want to take a snapshot, you can take it quickly. If you want a snapshot, you can take it. Okay, now let's move towards the financial instruments. We are discussing IAS 32 and IFRS 9, financial instruments, one of the important areas of paper F7. Let's start discussing the financial assets. What is a financial asset? Financial asset is cash. Cash is a financial asset irrespective of the currency. If it is dollars, rupees, pounds, euros, yen, everything is a financial asset. Equity instrument of another entity. If I have purchased ordinary shares of another entity, that is also financial asset. If I have purchased irredeemable preference shares of another entity, that is also financial asset, because this is an equity instrument of another entity. So any equity instrument of another entity is a financial asset. It may be ordinary shares, it may be irredeemable preference shares. Simran is saying, sir, in IAS 40, do we have the choice for subsequent measurement to value it at cost or fair value? Yes, Simran, we have a choice, either value at cost model or at fair value model. Both options are accepted. Bilal, you don't need to go into the details of transfer. Yes, Siraj, I will be providing the details of the. Okay, now, yes, Simran, initially everything is measured at cost, and then you have both the options towards the cost and the fair value. So financial asset is cash, equity instrument of another entity. By equity instrument, we mean ordinary share capital and irredeemable preference share capital. Ordinary share capital and irredeemable preference share capital. And the third point is contractual right to receive cash. Contractual right to receive cash would include receivables, trade receivables, and any loan to employees. If we have given a loan to our employees, that is a right to receive cash. We have the right to get our cash back. Similarly, loan to another company, which means purchasing any company's loan notes. If we are purchasing the loan notes, we are giving the loan. And if we are issuing the loan notes, we are receiving the loan. The purchaser gives the loan, the issuer gets the loan. The purchaser gives the loan, the issuer gets the loan. This is the difference. Okay, Sam, I will try if I can get if I can give a quick overview of that. So financial assets are cash, equity instrument of another entity, and right to receive cash. Now the financial assets can be classified at either fair value through P&L or fair value through OCI. They can even be classified at amortized cost. The total types of classification are basically 3, but normally in exam, the fair value through P&L or OCI are more important. So we are going to discuss these two. In fair value through P&L, these are initially recorded at fair value. These are initially recorded at fair value, and any transaction cost is expensed out in P&L. Subsequently, we are going to carry them at fair value, and all fair value changes will be taken to P&L. So normally the shares with a short-term intention are classified in fair value through P&L. Shares with a short-term intention are classified in fair value through P&L. Yes, Shiza, purchasing loan notes are financial assets. Exactly. This is what I mean. So shares with a short-term intention is classified at fair value through P&L. So, if the question says that we have acquired shares with the purpose of trading, our intention is to trade, that is a short-term intention. If our intention is to speculate, that is a short-term intention. So trading intention, speculation intention, short-term intention, these are all the same. These words can be used interchangeably, means the same. And if the shares have been acquired with a long-term intention, if the shares have been acquired for a long-term intention, then we are going to classify in OCI. So if I say we are purchasing the shares, what possible intentions can be there? 3 possible intentions can be there. Either we are going to earn some capital gain, or our intention may be to earn dividend for multiple years, or our intention is to get the voting right, the voting power. These are the 3 possible intentions behind purchasing shares. So out of these, the capital gain is a short-term intention, and dividend and voting rights are a long-term intention. So if I am purchasing the shares with an intention to get the voting rights, fair value through OCI. If my intention to purchase the shares is to earn the dividend, fair value through OCI. If my intention is to earn the capital gain, fair value through P&L. If my intention is to speculate, fair value through P&L. If my intention is to trade, fair value through P&L. These are all used interchangeably. Shazib, now you have to ask this later on, because That thing is already gone. Ayaz is saying why transaction costs are not capitalized, because Ayaz, if we capitalize the transaction cost, the asset will not be valued at fair value. If we capitalize the transaction cost, that will not be valued at fair value. So we want initially to be carried at fair value and the transaction cost to be expensed out, because this is a short-term intention. So the cost cannot be capitalized. However, if the intention would have been long-term, in that case the cost is capitalized. So when the intention was long-term, the transaction cost is capitalized. So if we are capitalizing the transaction cost, the asset would initially become at cost. The word cost means fair value plus the transaction cost. So in fair value through OCI, we are actually capitalizing the transaction cost and increasing the fair value to the cost of the asset. And subsequently, we are going to carry at fair value. This is the same. And all fair value changes are recorded in OCI. Why OCI? Because if I have acquired shares with an intention to vote, and a friend calls me and says, hey, you know, the share price has decreased. What would I say? I have purchased the shares with an intention to vote. Now my friend calls and says that the share price has decreased. What would I say? I would say I don't care, because my voting rights have not decreased and my intention was not to earn capital gain. My intention was to gain the voting rights, and the decrease in share price, I have no concern with it. So that is why we are not recording the fair value changes in P&L, but we are recording in OCI, showing the shareholder that we don't care about the movement of the shares. So that is why we are recording in OCI. Simran is saying that we always minus the transaction cost, whether it's financial asset or liability. No, Simran. In assets, we add it, and in liability, we deduct it. In assets, we add it, and in liability, we deduct it. In assets, we add it, and in liability, we deduct it. This is the difference. Okay, now let's discuss about the financial liabilities. What is a financial liability? Financial liability is a contractual obligation to deliver cash. Asset was a right to receive cash. Obligation is an liability is an obligation to deliver cash. Yes, Meta. The cost means the fair value and the transaction cost. So fair value plus the transaction cost is the total cost. So for example, if I have trade payables, that is a financial liability. If I have taken a loan from employees or loan from directors, the company has an obligation to pay back the loan. It is a financial liability. Similarly, if we have issued loan notes, so the issuer has a financial liability because he is gaining the loan, and the purchaser is giving the loan. The purchaser is giving the loan, the issuer is getting the loan. So for issuer, it is a financial liability, and for purchaser, it is a financial asset. Yes, Bilal, unidentified intention in shares will be at fair value through P&L. So let me add this as well in the previous slide. That fair value through P&L is the default category. Fair value through P&L is the default category, which means that if there is an unidentified intention, then we are going to classify it fair value through P&L. If there is an unidentified intention, then we are going to classify it at fair value through P&L. Simran, this is the answer to your question. That default category means if we don't know what to do, P&L. If we are not clear why we have purchased the shares, P&L. If we have multi-purpose intention, P&L. If the classification is not possible, P&L. Everything is in P&L if there's any confusion. Shiza Salim is saying transaction cost is expensed out, we will deduct from cost. No, Shiza, let me write down the entry. For example, the fair value is 100 and the transaction cost is 10. So for fair value through P&L, the entry is going to be financial asset debit by 100, P&L debit by 10, and the bank credit by 110. For fair value through P&L, this is the entry: financial asset at fair value, transaction cost in P&L, and cash in the total. But for fair value through OCI, the entry will be financial asset debit and the bank credit by 110. So this is the difference. In P&L, we are expensing the transaction cost, and in OCI, we are capitalizing the transaction cost. So in fair value through OCI, the asset is at 110, and in fair value through P&L, the asset is at 100. So now we are discussing the financial liabilities. Only 27 minutes are left in today's session. Kuratulan is asking the difference between preference, redeemable, and irredeemable shares. Kuratulan, basically preference shares which are redeemable are a financial liability, and which are irredeemable is an equity. Bilal is saying that there is always a difficult part A in ratios question to solve first, then calculate ratios and then interpret. So part A is too tough. Bilal, the entire life is tough, so there is nothing easy in the life. The ratios is, yes, a bit difficult, but this is what the life is all about. So we have to accept the difficulty and we have to get prepared for the difficult part. This is all what we can do. Calling it difficult won't make it easy, but preparing well will make it easy. So this is what we can do and we will try to do. Simran wants to be the last slide. Simran, quickly take the snapshot. Syed Maz is saying by the end of the class, please identify questions to practice of today's topic. Syed Maz, I have already provided day 1 relevant MCQs, which is available in the handouts. So day 1 MCQs are already there in the handouts. You can download that and you can solve those at home. Dania, no need to get into too much details of amortized cost. So what is a financial liability? Financial liability is a contractual obligation to deliver cash, such as payables, loan from directors, issued loan notes, and redeemable preference share capital. Redeemable preference shares are a liability and irredeemable preference shares are an equity. Redeemable preference shares are a liability and irredeemable preference shares are an equity. So now we are going to discuss two types: simple loan notes and convertible loan notes. Simple loan notes and convertible loan notes. Simple loan notes are a financial liability because we have to pay the cash back. But convertible loan notes is a compound financial instrument. What is a compound financial instrument? Which has both components of financial liability and equity. So convertible loan notes has both components, financial liability and equity. So we actually have to split both of them. We have to split liability separate and equity separate. So let's discuss how to account for the loan notes. We are discussing how to account for the loan notes, and we have an example that we have issued 5% loan notes with $100 million. So 5% is the coupon rate, the rate on which the interest will be paid. And we have given a discount of 7. We will be paying a premium of 3.24 and we have paid a transaction cost of 3. The maturity is 3 years and the effective rate is 10%. Smita wants to take the snapshot of the previous slide. Smita, here you go. Welcome, Smita. Okay, Samyula saying please give some extra time on ratios because examiner these days most favorite topic. Okay, Sami, I will try my level best to give as much time as I can. But also you people also have to understand that we have a limited time and a lot of things to do. So yes, ratios are too important, but it is 20% part of the entire exam. So we have also planned 20% time on the ratios, 15 hours, 20%, 3 hours for ratios. So 20% marks, 20% time allocated. But I will try my level best to make the ratios topic as much into detail as I can. Okay, now, so we have issued 5% loan notes at a discount of 7. This means that the amount that we have received is actually 93. So the entry is going to be bank debit by 93 and financial liability credit by 93. Then we have paid a transaction cost of 3. So this means the transaction cost has been paid, bank credit by 3 and financial liability debit by 3. So the financial liability would become 90 in this case. This would become 90 in this case. So if I look at one thing, the transaction cost has reduced my liability. But in case of financial assets, this would increase the financial asset. So if I say the transaction cost, this would increase the financial asset and this would decrease the financial liability. Increase the financial asset and decrease the financial liability. So now the liability is at $90 million. So debit is the bank, credit is the financial liability, the amount that we have received, and then debit the financial liability and credit the bank. So the amount we have paid 3 will reduce the liability. Now the liability is of $90 million. And now we are going to prepare a table, an amortization schedule, where we are going to write here, brought down, the interest expense using the effective rate, the interest paid using the coupon rate, which is $100 million into 5%. The difference is going to be the amortization and then the carried down. So if I write here 1, the brought down liability is actually 90 that we have just calculated. 10% interest expense of this is going to be 9. The interest paid that we have actually paid is 5. So the difference between the interest is 4. 9 minus 5 is 4. And the carried down is 90 plus 4, which is 94. So the carried down of the first year liability is 94. Now in the second year, this 94 will result in an interest expense of 9.4. The amount paid is 5, the amortization is 4.4, and the carried down is 98.4. And in year 3, which is the last year, 98.4 is the brought down. The interest is going to be 9.84, the interest paid is 5. The difference is going to be 4.84 and the carried down is going to be 103.24. So this is how we have prepared the table, and the amount we have got the same. The premium, 100 was the par value and 3.24 is the premium. So the carried down should be 103.24, which we have got. So this is how we actually prepare the table, and now we are going towards the accounting entries. And Simran is saying, sir, is this area or advance? Simran, the interest is always in areas, never in advance. The interest is always in areas, it is never in advance. So you don't need to see whether it's areas or advance, it is always areas. But in IFRS 16, there may be the rentals may be in areas or in advance. But in IFRS 9, there's nothing such thing. Okay, Coolies is asking why face value of 100 is not used to complete the effective rate. Coolie, actually, the problem is that we cannot go into too much conceptual details in the webinar. So right now we are solving of how we are looking at how to do this rather than why to do this, because the examiner is not going to ask you how, why. Examiner will ask you how. Yes, Bilal, amortization means the rollover. Briefly explain the rationale of the table. Bilal is asking what will be the current non-current liability. Bilal, everything is a non-current liability. the current and the non-current is being divided in IFRS 16, not in IFRS 9. Under IFRS 9, everything is a non-current liability. So the rationale behind the table is basically, if we see, let me explain you people something which will not be asked in the exam, but I will take only 2 minutes because only few time is left for us. If I see in this entire question, we have given a discount of 7. This is an expense to us. We have given a premium of 3.24. This is also an expense to us. We have also given a transaction cost of 3. This is also an expense to us. If we calculate the total expense, this is of 13.24. This 13.24 is something extra over and above that we are paying other than the interest. This 13.24 is something extra above the interest that we are paying. So this 13.24 is an expense to us. But for which year? This is expense for which year? Year 1, 2 or 3 or all of 3? What do you people say? This 13.24 relates to which year? Year 1, year 2, year 3 or all of the 3 years? Yes, this basically relates to all of the 3 years. Yes, Simran, if somebody is issuing, means they are getting the loan. So this is an expense which relates to all of the 3 years. So this should be divided between 3 years. And if you calculate the sum of the amortization, you will get the same 13.24. So in this table, what actually we have done is we have divided, we have amortized, we have splitted this 13.24 into 3 years. So this is what we are doing through the table. The interest that we are paying is 5 in each of the years, and the amount that we have divided into 3 years is 4, 4.4 and 4.84. So we have got the total expense. Shazib is saying why discount and premium is an expense. Shazib, if I'm getting less and paying more, this is an expense to me. If I'm getting low, I'm getting 93 and paying 103.24. So the differential is an expense to me. Zuhaib is saying if I took loan from the bank of $100 million and they charge $10 million finance cost that they deduct upfront from finance cost. Shazib, the question you want to ask relates to actually P2 level, so that is not relevant to F7. Smita is again asking why discount is an expense, please. Smita, if I am giving a discount to someone, this pen is of, let's suppose, $80 and I'm giving to you at $60, then $20 is an expense to me, obviously. So the discount and the premium is always recorded as an expense. Sayyid Saad Farouz is saying that, sir, this is compensated by the low interest. Yes, Saad, that is why we are recording the expense at 9. Because this is low and has been increased because of this, so we have increased 4 and the total expense is 9. So we are recording the effective rate that in actual we are charging. Okay, now let's move further, otherwise we will be discussing this again and again. And we have 15 minutes left now. So example number 2 is about convertible loan notes. Let's discuss this. So we have issued $100 million of convertible loan notes. We have issued $100 million of convertible loan notes with an interest rate of 6. The maturity is 3 years. The effective rate is 10%, and these are convertible into 25 million shares. Now if we see, we have received an amount of 100. So the entry should be bank debit by 100. But the entire amount is not a liability. This also includes an amount which is a part of equity. This also includes an amount which is a part of equity. Okay, Shazib wants to take the snap of the previous slide. Here you go, Shazib. Okay, so now out of this 100 million, this 100 million includes both a liability component and an equity component. Now we need to split both of them. How do we split them? is that we basically calculate the present value of all future cash flows, and that would become the financial liability. So financial liability is present value of all cash flows. So the maturity is 3 years. So I'm writing year 1, year 2, and year 3. The cash flow is 100 into 6%, which is 6, 6, and 106. Why 106? Because in year 3, we are paying the interest as well as we are repaying the loan. So 6 and 100 is 106. Both the amounts are going to be paid in the last year. And the discount factor for 10% is normally 0.909, 0.826, 0.751. Normally in an F7 paper, these discount factors will be given. So you should not know how to calculate these. These will be given in the question. So now we have to calculate the present value of all these. So 6 into 0.909 is 5.45. I'm calculating at 2 decimal place, 5.45. And then 6 into 0.826 is going to be 4.956. So 4.96. And 106 into 0.751 is going to be 79.61. Now I'm going to add all these. 5.45 plus 4.96 plus 79.61 is going to be 90.02. So let's say 90. I'm using a rounded off value as 90. Thank you, Faraz. So the present value of all future cash flows is actually 90, and the remaining amount of equity is actually 10. So this is how we are going to record the convertible loan notes initially at year 0 when we have issued them. Yes, Simran, this is a hybrid instrument. Convertible loan notes, hybrid, compound, interchangeably used. So the first step was to split the convertible loan notes between the liability and the equity. Now the second step is the same to prepare the table. Now in year 1, the brought down liability is 90. The interest expense will be using the effective rate of 10%, which is 9. The interest paid is 6, amortization is 3, and the carry down is 93. Now for the financial liability, we are preparing the table. Okay, Dani is asking where did 6 came from. Dani, 6 is $100 million of the face value, par value into 6% coupon rate. 100 million par value into 6% coupon rate. And Cooley is asking how did you get the discount factor. Cooley, discount factor is 1 divided by 1.10 to the power n. So power 1 for the first year, power 2 for the second year, power 3 for the third year. Ali is saying I'm a bit confused. When shall we deduct the transaction cost and when we are adding the transaction cost? It is simple. Ali, it is simple. If it is a financial asset, add it. If it is a financial liability, deduct it. Transaction cost is being added in the financial asset and deducted in the financial liability. Added in the financial asset, deducted in the financial liability. Okay, Simran is asking what's that 9, 6 and 3. Simran, 90 million was the loan, and using the 10% effective rate, 90 million into 10% is 9. This is the interest expense. Interest paid is 6 that we had calculated in the cash flows. And the difference, 9 minus 6 is 3, which we have paid less. So now we have to pay the 90 plus the less amount of interest of 3. So that would become 93. Mohammed Hunain is asking, sir, can you please clear the third year 106 cash flow? Hunain, in third year, I am going to pay the interest of 6 and the repayment of loan of 100. So total 106 is going to be the amount paid. 6 of interest and 100 for the loan. So total is 106. Ali Malik is saying, what about the financial instrument of equity? What will be the treatment of transaction cost? Ali, are you talking about equity instrument of another entity or equity instrument of the same entity? If you're talking about equity of the same entity, this is not IFRS 9. If you're talking about equity of another entity, that is a financial asset and will be capitalized, added. If you're talking about equity of another entity, it is a financial asset, this will be added. Faraz Ahmed wants some homework relating to these topic, section B questions. Faraz, I have already uploaded the homework questions. I've already uploaded the homework questions. Let me show you the slide. This is the PDF relating to section B questions that you have to try at your home. And this question has already been uploaded. So this is the question, 5 questions relating to one question and then 5 questions relating to the other. So you people are expected to solve these at home. But if we haven't completed IFRS 15, then you cannot obviously solve them completely. So these questions are for home. Thank you, Lee. Hamza is saying, sir, can you please tell why you split this loan notes between financial liability and equity? Hamza, basically, in case of a convertible loan notes, the loan note holder may ask for cash at the end. So if the loan note holder asks for cash, I have an obligation to pay cash. This is a financial liability. Obligation to deliver cash. I have an obligation to deliver cash liability. And if the loan note holder asks for the shares, I don't have any obligation to deliver cash. So if it requires cash, I have an obligation. If it requires shares, I have no obligation. Now, do I have an obligation or not? I have actually both, an obligation and not. So the obligation is liability and not obligation is equity. So that's why we are splitting it into both. Yes, Shiza, debt component will be treated as a liability in the balance sheet. Yes, Shiza. Okay, Mohammed Hunain is asking why transaction cost reduces the liability and increases the financial asset. Mohammed Hunain, again, we are not having time for why, because this is something which is not being asked in the exam. So examiner is not going to ask you why, he's going to ask you how. So in a short session of 15 hours, we cannot discuss these into too much detail. Okay, Saad Farooq, thank you so much for the calculation. Simran is saying, what's a dead component? Simran, this is not a dead component. This is not a dead component. This is a debt component. Debt component means liability, financial liability. Okay, Simran, so there is nothing as debt component. It is a debt component. Okay. Now let's prepare the table for year 2. The brought-down is going to be 93, 10% is going to be 9.3, interest paid is 6, amortization is 3.3, and the carried down would become 96.3. And in the last year, 96.3, 10% of this is going to be 9.63, interest is 3.63, and the carried down is going to be 99.93, which is approximately 100. So this is how we are going to prepare the table. This is how we are going to prepare the table. And then the last thing, what entry are we going to prepare for year 1? The entry is going to be finance cost debit by 9, which is the interest expense 9. The amount that we have paid from the bank is 6, bank credit by 6, and the financial liability will be increased by 3, so that the value of 90 can be increased to 93. The value of 90 can be increased to 93 by crediting the liability. Similarly, if I'm preparing the entry for year 2, I would say finance cost debit by 9.3, bank credit by 6, and financial liability credit by 3.3. So these are the entries, and the time's up for today. Signaling effect from the admin about the time that it's over. Okay, so we have completed IFRS 9 now. You have to try this question at your own, and then we will be discussing in tomorrow's session. You have to try this at your home, and then we will be discussing in tomorrow's session the question of candy and the question of extol. Try this at home. Thank you, Assam. Assam is saying, Alhamdulillah, this is the best webinar. Thank you. Okay, now I'm actually sharing few information with you people. So I'm giving you people my personal number, but please try not to call. Only contact me on WhatsApp. My number is +92, the country code 334 3739 697. You can drop me an SMS on WhatsApp. I will send you the group link over there, and then you can get added in the WhatsApp group, and then you can continue the discussion over there. Okay, Kashif, thank you so much. Simran wants to view the previous slide. Simran, this is the previous slide. Ayaz, thank you. Ayaz saying that this is the best lecture. Great, sir. Thank you so much. Okay, so that's all for today. Your feedback is very important. Do provide us the feedback for today's session on this question bar and when the session has been ended, because your feedback would provide us the ability to improve even further. And thank you so much, everyone. Looking forward to continue tomorrow. And if we are not able to complete tomorrow's session, we will be probably increasing the session for 15 minutes or 30 minutes with your consent. So do provide the feedback, remaining questions over the WhatsApp. Thank you, everyone. Take care, and Allah Hafiz.